Keycap 1 Introduction to External Sector. The external sector of an economy refers to all economic transactions between a country and the rest of the world. It includes trade in goods and services, cross-border investment flows, external borrowings, remittances, and foreign exchange reserves. India is not a closed economy. We are deeply integrated into global trade, capital flows, and supply chains. Therefore, understanding the external sector is crucial for analyzing macroeconomic stability. In UPSC, external sector questions test three things: conceptual clarity, data interpretation, policy implications. A stable external sector ensures exchange rate stability, sustainable growth, protection from global shocks. Balance of payments, BOP. The balance of payments is a systematic record of all economic transactions between residents of a country and the rest of the world over a specific period. It has two major components. First, the current account. Second, the capital account. The current account records trade in goods, trade in services, remittances, investment income. The capital account records foreign direct investment, foreign portfolio investment, external borrowings, changes in foreign exchange reserves. The key identity is current account deficit must be financed by capital account surplus. If not, Forex reserves decline. For prelims, remember, BOP always balances in accounting terms, but deficit or surplus refers specifically to the current account. Current account and current account deficit, CAD. Current account deficit occurs when imports exceed exports of goods and services. For India, the major contributor to CAD is crude oil imports. Gold imports. India traditionally runs a trade deficit in goods but a surplus in services, especially IT services. A moderate CAD, typically around 2% of GDP, is considered sustainable. However, high CAD can depreciate the rupee, increase inflation, reduce investor confidence. In GS-III answers, always link CAD to energy dependence, global commodity prices, export competitiveness, capital account and capital flows. Capital inflows help finance CAD. There are two major types: FDI, foreign direct investment; long-term, stable, technology transfer-oriented; FPI, foreign portfolio investment; short-term, volatile, sensitive to global interest rates. India also receives external commercial borrowings, NRI deposits. The problem arises when CAD is financed by volatile capital flows like FPI instead of stable FDI. This creates external vulnerability. UPSC often asks, which capital flow is more stable? Why? Answer: FDI is more stable because it is long-term and linked to productive assets. Exchange rate systems. Exchange rate is the price of one currency in terms of another. There are three types: fixed exchange rate, government decides rate; floating exchange rate, market decides rate; managed float, market determined but central bank intervenes when necessary. India follows a managed floating exchange rate system. RBI intervenes to prevent excessive volatility, maintain external stability. Depreciation makes exports competitive but increases import cost. Appreciation reduces imported inflation but hurts exporters. UPSC mains answers must show this trade-off clearly. Foreign exchange reserves. Forex reserves include foreign currency assets, gold reserves, SDRs, reserve tranche position in IMF. Reserves provide confidence to investors, buffer against external shocks, ability to manage currency volatility. One important indicator is import cover, how many months of imports reserves can finance. Adequate reserves reduce risk of balance of payments crisis. India's large reserves act as a shock absorber during global crises. External debt and vulnerability indicators. External debt refers to total borrowings from foreign sources. Key indicators include external debt to GDP ratio, short-term debt to reserves ratio, debt service ratio. Higher short-term debt increases vulnerability. The 1991 crisis happened due to high CAD, low reserves, high short-term external debt. UPSC frequently expects you to connect current data to lessons from 1991. Trade policy and WTO context. Trade policy aims to promote exports and regulate imports. India uses tariffs, export incentives, production-linked incentive schemes. Under WTO rules, India must comply with global trade norms. Trade agreements influence market access, supply chain integration, strategic partnerships. In mains, always link trade policy with Atmanirbhar Bharat, global value chains, China +1 strategy. Recent trends in India's external sector. India's merchandise trade deficit remains significant due to energy imports. However, services exports are strong, especially IT and business services. Remittances from the Indian diaspora are among the highest globally. Forex reserves remain comfortable despite global volatility. Capital flows fluctuate due to U.S. interest rate movements and geopolitical tensions. UPSC loves linking. Global events right pointing arrow capital flows right pointing arrow rupee movement right pointing arrow inflation. Prelims trap areas. UPSC tricks candidates by confusing capital account with capital account convertibility, mixing current account with fiscal deficit, testing understanding of SDR, reserve tranche position, asking about components of Forex reserves. Always revise. Definitions. Which items belong to which account? RBI's role. Conclusion. India's growth story depends heavily on external stability. A sustainable current account deficit, adequate Forex reserves, diversified exports, and stable capital inflows are essential for macroeconomic resilience. External sector management is not just about trade. It is about economic sovereignty, policy credibility, and crisis preparedness. For UPSC, mastering the external sector means mastering macroeconomics. If you enjoyed this video, don't forget to like, subscribe, and share the channel. Thanks.